Hi, good morning. We'll start today's webinar. Today is 7 Jan 19. So in today's webinar, we'll talk about Singapore commodity sectors update, China weekly musings, US recession indicators, as well as Phillip Singapore's weekly. So firstly, we will talk about the coal sector. Okay, in China, the battle for a blue sky will continue this year, so that means it will curb the coal consumption and production. This policy is in line with what the government stated in the 13th five-year plan. And also, by the end of last year, the NDRC already encouraged major power generation company to sign the medium and long-term coal purchasing contracts with the coal producers. That means this year the domestic coal prices will be more stabilized in China. And if we take a look at the import and domestic production comparison, actually in 11 months last year, the domestic production only grew by less than 1% year on year, while the coal imports surged 9.3%. That means actually the shock of domestic supply was replaced by the coal imports. So you can see here, since 3Q last year, coal prices started to correct. That was mainly due to China reimposed the restriction on coal imports. So the catalyst for the Singapore coal sector is that the two coal counters will continue to ramp up production by average 40% this year. So our rating for this sector is overweight. Next is the offshore and marine. We think that the recovery will continue to be slow. So let's see this chart. Actually, this is the day rate as well as the utilization rate of the jackups and semi-subs. You can see here, though the utilization rate improved slightly, the day rates are still soft. And we think that the oil prices will be average between $65 per barrel to $80 per barrel this year. This is the Brent price. And for the CAPEX and OPEX wise, the oil majors won't improve or increase the spending on both sides this year. So that means the CAPEX and OPEX will remain tight in this sector. And also, if we look back last year, the geopolitical risks are increasing, especially the US sanctions on Iran, as well as the tension between US and Saudi. But we do think that these risks are the noises to the sector. And also we see that the gas sector will have a strong momentum because especially in China, the demand for natural gas hit a new high last year. So all in all, our ratings for this sector is underweight. So next is the US oil market. This is quite important because last year, US already ranked the top oil producer globally. So you can see that as of December last year, the US oil output hit a record high of around 11.8 million barrels per day, and 70% of this output are from shale oil. And this year, the guidance from EIA is that the growth of US oil production will be around 1 to 1.5 million barrels per day. That means the upside for the growth wouldn't be much. And if we take a look at the US weekly oil stockpile, since fourth quarter, the inventory level increased moderately. That explains why the oil prices started to drop in 4Q. So if we compare the 2018's level to 4 years ago, actually the current inventory level was not that high. Another sector is utilities. We'll talk about three markets. In China, last year the power demand was strong. In 11 months, the growth rate was about 8.5%. This was quite short because last year the China's GDP growth was around 6.5%. And for this year, the guidance from the authority about GDP growth is 6.2%. So we expect that the power demand in China will be lower than last year. But still, we think that the demand is quite healthy. So in India, some of the power plants are still suffering from the lack of long-term PPAs. That means they will subject to the spot tariff and the fluctuation of the spot prices. And also in India, the government push the renewable energy development. So we think that this is a growing sector in India. So in Singapore, the intense competition due to excessive supply of power will continue this year. Because as of last year, end of last year, the reserve margin was around 90%. Though this year, the EMA guided that there will be 900 megawatts of capacity exiting the market, that will bring down the reserve margin to more than 70%. This is quite high. This is a quite high number compared to the minimum requirement of 30% of reserve margin. So our rating for this sector is overweight. So the next is our two stock picks for the commodity sector. First one is geoenergy. So this last year we expected the production dropped a little bit compared to 2017. There was the production target miss was mainly due to the maintenance work on the ground field. However, since the company already acquired the new mine, TBR mine, in 3Q18, we expect that this year there will be a significant ramp up of production this year. So the expected growth rate of production will be 33%. And another catalyst for geoenergy is that the potential M&As will be announced this year, because at the beginning of 18, the company successfully issued a senior note worth of $300 million US. So based on the confidence of this note, the company need to deploy cash to acquire other assets. So high chance the company will acquire another coal mines this year. And also based on the track record over the past 3 years, the company gave out dividend of 1 US cents. So based on the price of 17 cents SG dollars, the dividend yield is about 6%. This is quite attractive compared to other coal counters. So our rating for this company is buy, and the target price is 24.5 cents. So next is China Sunsine. China Sunsine is one of the few top performers last year. Why? Because if we take a look at the margins, this chart shows the spread for the Accelerator and Antioxidant compared to the raw material prices, aniline. So you can see that last year, since 3Q, the aniline prices dropped significantly, while the ASP didn't drop a lot. That means the margin was expanding in the second half of last year. So the catalyst for China Sunsine is that they already got the approval from the government of the trial run of the insoluble sulfur, and we expect that for the TPPS expansion, capacity expansion, will be announced this year. So the production growth for these two products will be 50% and 12% respectively. And also we think that GPM and NPM will be maintained at around 30% and 15% respectively this year. Since the China authority continue to restrict the environmental pollutions, we think that China Sunsine will be benefited because they are the market leader, and over the past 10 years, they were doing quite well in terms of the environmental protection. And by the end of last year, we expect that the cash in hand will hit billion RMB. And lastly, we think that the dividend will jump more than 50% last year because the company have a constant payout policy of no less than 30%. So our rating for this company is a buy with a target price of $1.68. Next, I will pass on to Mike.
Thank you, Guangzhi. For China last week, for the fiscal policy side, we noticed that there is a 17 Tier 1 and a part of the Tier 2 city lower the first housing mortgage interest rate. Given what the China government said on December's economic conference, it gave the cities the more powers to modify its housing policies. We are looking for the average housing price of the 7 cities this week. Also, China government cut the tax for small and medium enterprise. From this, we can see the China government is still focused on stabilize this growth. For the economic indicators, the China December CPI is the growth to 1.9% year to year, lower than expectations. This is because of the coal and oil prices is decreasing more than expected. Also, the China December's the PPI is 9.9%, also lower than expectations. For the stock recommendations, our Hong Kong research teams recommend China Soft Internationals. This is because there is no significant impact on Huawei incident. They give the PE ratios of the 2019 about 16.5%. For this week, we are looking forward to China's December's export numbers, also the average housing price of the 70 cities. This is a list of the Hong Kong research team's recommendations. It contains the BYDs, Kingsoft, GAC, Sunny Fissions, China's TCM, Ehai Internationals, and the China Soft Internationals. I will move to Edmonds for the US recession indicators.
All right, thank you, Jian. So right now I'll go on to talk about the US recession indicators. So one of the key concerns that a lot of investors had is whether there's going to be a recession in 2019. So based on our 17 Phillip recession indicators, you can see that everything looks good so far. There's only two indicators that may spell a little bit of concern. So the first would be the S&P 500 index. It has gone below the 10-month moving average, while the unemployment rate is currently above its 12-month moving average. I just to check whether you guys can hear me. Okay, so I'll continue. Yeah, you want to expand the table. Can you guys see the table currently? Or is it too small for your screen? Okay, never mind, I'll just continue on. So I'll move on to the S&P 500. So you can see that currently it's below its 200-day moving average. But from the historical figures, we can see that there are many times whereby it has crossed above the threshold, but there was a sharp correction onwards, forward. So we predict that going forward, there's going to be a rally in the coming months, and the S&P 500 is likely to experience a sharp correction. And especially because we believe that the trade war is going to reach some sort of deal between US and China. There's going to be a discussion between the Vice Premier of China, Liu He, and the US Trade Representative and the Secretary and the Treasury Secretary in late January. The unemployment rate is also currently above the 12-month moving average. But of course, of all the indicators, there's only two that has shown somewhat some sort of concern. So we believe that we should look at all the indicators in totality, and we'll continue to monitor and see whether there's any further cause of concern. So if this trend continues, we believe that it is highly unlikely for a recession to occur in 2019. And what this means is that based on our previous webinar, we believe that we are still overweight on the banking sector, and some of the ETFs that tracks the banking sector would be the KBW Investco Bank ETF and the Nasdaq Bank ETF. So right now I'll pass on my time to Paul, who will talk more about Singapore Weekly.
Okay. Thanks, Simon. We'll just run through our usual weekly updates for week 3 of Singapore market. Okay, in terms of the macro so far, if we start off with Singapore, it's still very sluggish. I think we saw construction contracts being awarded down almost 34% for fourth quarter so far. And also retail spend is also sluggish at 0.3% year on year. When you look into the US, I think obviously the one that helped prop the market up was the Powell's comment at the Economic Club that he can be patient and flexible. So the higher chance now of the Federal Reserve pausing their interest rate hikes. And also looking at the Fed minutes for December that came out, it just showed that the Federal Reserve members were all very worried about the global growth situation, and especially the trade tensions. The big macro data point from the US is of course inflation. Inflation is moving sideways because core inflation was 2.18% and unchanged. So basically, it gives cover for the Federal Reserve to pause interest rates hikes. In terms of some of the key corporate or sector, I'll move to the capital one later. Just some snippets. The Malaysia palm oil inventory, one big news that came out was the palm oil inventory out of Malaysia. It is an all-time high, a 24-year high actually, because since the data was released. So it's 3.2 million in December. It's actually up a massive 18%. The other piece of sector news was, I think, without having to beat the horse down for smartphones, just to reinforce that smartphones remains very weak. In December, the shipments were down 70% in China, and it's the second year of decline for smartphones in China. In terms of the corporate news, we had the Ascott Resident Trust. I think the important part was probably they were sold for 64% above market valuation. It's actually a conservation building, so you cannot tear it down, but it's still zoned for commercial, so it's unclear if the buyer will use it for office or he could maybe just widen the rooms and just like add more rooms space to make it a hotel. And the other thing is that there's also news of Oxy selling the Mercure Novotel. So there's a lot of buzz around the hospitality assets right now, so that should be supportive for any hospitality REIT, especially those that have a lot of assets in Singapore. Okay, the big news, it came out only in this morning. Our analyst Tara is at the CapitaLand briefing. So I'll just give you some of our initial thoughts, at least my initial thoughts on the CapitaLand. So for those who do not know, this morning CapitaLand announced that they will be swapping. Temasek has a stake in Ascendus, and then so Temasek will be swapping their stake in Ascendus with some CapitaLand shares and cash. For us, we view it as a positive. According to CapitaLand, this is of course EPS and ROE equity. So number one, that's the reason. Number two, it was also acquired at a premium to CapitaLand shares at 350. So that's another reason why we like it. And number three, the reason why we like this deal is because it will expand the recurrent income. Because this Ascendus Singbridge has about asset under management of 23 billion. So these are some of the positives why we think this is a good. As you all know, our story for CapitaLand is that we like CapitaLand because not so much because they are winding down some of the more volatile property development earnings and shifting more to the higher quality recurrent incomes like asset property management, and REIT management and so fund management and so forth. So that's why we always had we were pushing for CapitaLand. So this is a positive. Some parts of the deal is basically Temasek stake will raise from 40 to 51. And the deal is worth about 11. This is just some basic stats if anyone wants. Okay, in terms of our short-term tactical call, we think we should we will take on more risk because we think that despite all the bad news that's happening, the markets are still rising and sentiment we think could turn further if we have there's a few more events out there that could actually turn the sentiment even more positive, such as the trade deal between China and US, and also the shutdown will end, and also the Fed pause. And also as China continues to stimulate the economy. So we think all these things could actually help make sentiment for the markets in general even more positive. And in terms of weeks ahead, the key news event will be the Brexit vote, and also below are some of the results that's coming out. I think most of the results will start coming out in Singapore in the following week from the 23rd, as you can see all of them, and the 22nd Feb for some reason the two banks are releasing at the same time. I think okay, all right. Thanks. That's it for our webinar. If you have any questions, please post them. Thank you. Yeah, hi. We'll try and answer some of these questions. Hold on for the M1 one. We're just doing some check. Anyway, one of the questions is that higher palm oil inventory a sign of slowing demand? It basically just tells us that there's a big mismatch between demand and supply. Obviously, initially the market was there was a small rally on the palm oil stocks because India cut their import duty, so that kind of benefited. But this huge inventory will be a bit of an overhang for all the palm oil stocks. It's just a sign that there's overproduction. I mean, nothing unusual about it. Just sign that there's overproduction of palm oil. But the only thing good for palm oil is that because of the inventory, this inventory, there's a bit of perishability in it because the inventory is actually quite palm oil actually can turn acidic and so forth. So this inventory, while it's negative, it has to wind down on its own because it's not like crude oil inventory that can actually stay for many years. This actually can, excluding storage costs, but because of the quality is affected the longer you keep the inventory. But it's a big negative. I mean, when you have a record high in inventories, it just shows that there's overproduction. Okay, the other question is how would acquiring the acquisition affect A-REIT and CapitaLand investors? Okay, this one doesn't affect any of the REITs because this is like let's say you take Ascendus or Ascendus Hospitality or Ascendus India. This is the parentage that's affected. So there's a new shareholder for all the REITs. There's no change in any of the. Doesn't affect the REIT on its own, but it just affects the parent. There's a new parent, but ultimately it's still Temasek. But just that on paper, there's now CapitaLand is the new parent rather than Ascendus Singbridge. But for us, like we said, we view it as a positive deal for CapitaLand. Why is Oxley selling off the hotels? I think the clear answer is we don't cover Oxley, but I guess the clear answer they need to deleverage. I think the overhang for Oxley has always been the high gearing levels. Yeah. Thanks. I hope that answers the question. One more question is what's the difference between A-REIT and Ascendus SB? A-REIT is the Ascendus REIT that listed, and Ascendus SB is the parent. Yeah, thanks.
Hi, there's a question on M1. What's your view on M1 now that shareholders receive letter to sell? How does this work? We think shareholders should accept the offer at $2.06. Right now, the offer is still pending IMDA approval. I guess the market is trading above the offer price is because there's dividend that's still in play, that shareholders that can get dividends once they accept the offer. There's also another question on SG Telcos. Any comments on SG Telco's stock price movement on TPG starts the trial run effect? So TPG has announced that they'll give 20,000 subscribers free data plans. So this 20,000 is only 0.34 of mobile postpaid customers, and it has marginal effect. I think with TPG, the key thing is to take note of their capex level. Right now, they have spent less than 100 million out of their 200 to 300 million announced capex plan. So there's a question of the reliability and quality of the network. So as of now, we do not think TPG is a serious threat until we see a huge jump in capex. There's another question on what's the possible target price for CapitaLand. Our analyst is at the briefing now, and she will give updates about this. Our current target price for CapitaLand is $4.
Oh, sorry. There's one question on Oxley Holdings' latest selling effect on the share price movement. Sorry, we don't really cover, but I guess if any measures, but in general, that's a general statement. I think any initiatives that they do that can help de-gear the balance sheet will be like what they do, like selling such assets, because there's also debt tied to the assets. So it will be positive for the company. Because like we mentioned, their gearing has always been a bit of an overhang on the share price. So any efforts to reduce gearing or to sell assets has been positive. Because as you know, the last 1-2 years, they've been heavy on their acquisition from the office towers to also bidding for land for development. So any selling right now of the assets, yeah, will be positive. Thanks.
Yeah, so there's a question on what's the effect of the US shutdown on the market. So historically, even though there's a few shutdowns, but then the stock market continues to rally. And so far, although this is the 24th day of the US shutdown, but currently the US share price only shave off like 0.1%. So currently, I guess that there is not going to be a cause of concern. But of course, if it continues for another week or another 2 weeks, then perhaps there will be a bigger effect on the US market.
Okay. We have a question. Can they have any serious talk with China on trade? Yeah, I think in our 2019 strategy, we mentioned that a few reasons why we think there will be a positive conclusion to the trade talk. Firstly, I think like we mentioned before, I think Donald Trump has reversed many hard stances before. As you recall, he said many nasty things to North Korea, to Iran, and then a couple months later they were shaking hands and he removed a lot of the oil sanctions. That's number one. Number two, so far none of the tariffs actually have affected his vote base, apart from those as you know, China has also retaliated on especially importing from soya beans and so forth. But US has actually given grants to some of these farmers, so none of his voting base, you can say, has actually been directly affected. But as if there's a full-blown trade war, almost 150 billion of consumer products will be affected, and these consumer products will be hit with higher prices and so forth. So he can't afford all these things to happen, especially with the 2020 presidential elections. Then number three, of course, you know, he's not a dogmatic person. I mean, he's doing just one deal to another. Then number four, I think it's quite well known, it's publicly known, one of the biggest funders for the Republican Party and also Trump has casinos in Macau. So I think you can draw your own conclusion from that. Yeah, thanks. Okay, if there are no more questions, oh, sorry, if the there's one more call, view on JPM to reduce on S-REIT holdings for a year. Sorry, we're not sure the rationale why they actually had the reduce on S-REIT. If you want more details, sometimes you can go to our website, our stocks BNB. You can just post the questions and we can go check it out. Because right now we do not know what's the rationale why they had a reduce. Because if you don't have the rationale, then we can't really answer why they actually had a reduce. But if you post the question in our stocks BNB, we can actually help try and look into it. As you know, stocks BNB is our research website. You can actually post questions there. Yeah. Okay, thank you all for dialing in and especially for all your questions. We welcome any questions. Thanks for dialing in, and we will hope to see you again next week. Thank you, everyone.